Hello and welcome back to Nolan Financial Radio. My name is Tara Nolan from Nolan Financial. If you're new to the show, welcome. We are going to be talking today about what the Fed rate hike means for you. So, we've been talking about inflation and what we thought the Fed was going to do. So, this is going to be another great show to help you understand this. If you're new to the show, I would just tell you that you are free to give Chris and I a call at 719-210-4242. If you want to set up a complimentary discovery call to ask more questions, especially as we go through the show, we find out a lot of people go, I really wonder how that applies to me. And so definitely give Chris and I a call at 719-210-4242 to set up that discovery call to see if you're maximizing everything that you can be doing in your life. Because, we don't want to change what's working, but we sure want to make sure the holes and gaps are filled. So also visit our website at www.nolanfinancialpartners.com. And while you're there, you can click on the radio page because we record all these shows and we save them. And a lot of the past shows will talk about anything from Medicare, IRAs, simple plans, almost anything to do with money. There's going to be a show on it. And we really feel like the best thing you can do to get started for your financial success is educate yourself. So while you're there, you can subscribe to the program on Apple Podcasts, Spotify, Google Play, whatever is your preference. There's a platform there. So again, please don't hesitate to reach out to us with questions or to set up a face-to-face or virtual meeting. So we're going to jump into about the Fed rate hike and what does this mean to you in your life today? Because that's always the big thing is we hear about things in the news and there's a lot of hype. And what we really want to know is, does this really matter for me in my daily life? Or is this just like, aha, good to know information? But before we jump into that, I wanted to say hello to my co-host, Tony Shore. Tony, what's up?
Well, I'm just excited to be here again, and you're right. You're picking topics that are definitely in the news. This is a headline topic when the Fed raised the interest rate, so I'm excited about that. And yeah, I've just been crazy busy trying to figure out how to possibly maintain my backyard while having a huge 75-pound dog run and tear through it constantly. It's not easy to get grass to grow back there and keep those spots. I can put seed down, but if we let our dog back out there, it's you got to let the dog out, right? So I've been dealing with that, trying to get my yard back into shape. I'm not having any luck with that though, Tara. How about you? What's been going on with you?
Oh, our big thing, we're managing a much bigger yard. It's about 20 acres. And
Yeah,
here in
you've got a bigger
Colorado,
yard than me.
we have this kind of cactusy type spiky plant called soapweed that it's the only thing that grows when we don't have rain. And our neighbor, a good friend of ours, has loaned us his skid steer, which is the only thing that can dig those suckers up. And so we are in the process
Wow.
of digging those things up. And then you have to get them out of the pasture and actually throw them away because this plant is amazing, actually, because if you just drop it somewhere, it will take up root and just start spreading. So
That's crazy.
it's I wish horses could eat it, but they it's too spiky and sharp. They won't eat it.
Yeah.
And
Yeah.
it just takes over. So
Yeah. Wow, that's not good. That sounds like a bad plant. And why is it that the bad plants are the toughest ones? I mean, if we try to just grow grass or a hay, you have to take so much care to keep it growing and keep it nice, but weeds will grow like, well, weeds.
you're right. It's just
Yeah. We have in our backyard, it's not that plant. We have a different plant that's like that. It's called buckthorn, and we have buckthorn everywhere. And we've cut it down, we've pulled it out. We've doused that hill where it grows with horrible chemicals. It comes back. It doesn't matter. It doesn't care.
oh yeah.
Buckthorn doesn't care. It just comes back. So yeah, we're dealing with that as well. But besides our yard and plant problems, we've seen a lot in the news lately between inflation. Again, we talk about these things a lot, but they are on the top of mind for most people. And now the Fed, they're trying to, I guess, prevent another recession or deal with inflation. So they've raised the interest rates, right?
Exactly, Tony. And we've talked about this before, but I think it's you can't talk about it too much because it's a little bit complicated to understand. But when inflation happens, essentially at a large scale, what's happened is there's more money available than things to buy. And it's usually, we saw this coming with the supply chain issue problems that we were having. The
Hmm.
the war in Ukraine was interrupting our supply chain system.
Hmm.
And so, remember we had all the cars just sitting because they needed that chip to finish up the car. And so
Yeah.
people were ready to buy a car and they couldn't buy a new car because they weren't available for sale because of the supply chain issue. And so he started creating a situation where there's more money kind of out in the system than there is availability to buy stuff. And
Mm.
the super frustrating part, though, Tony, is it's not an even peanut butter spread. So it's really frustrating for someone who's going to work and they've got their big diesel truck, like, Chris and I have our old 250, and you pull up to the pump and you fill that thing up and you go, holy man.
Yeah. Yeah.
And I'm like, I don't have extra money in my pocket just sitting around to put this kind of, put gas in the car, diesel in the truck.
Yeah.
Um, but on a larger scale in the economy, there is more money out there. And so inflation starts to happen because guess what? Supply and demand, people that sell things, if they can charge more money for it, guess what? They're going to do it.
Yeah.
And,
They will. They will. Yeah.
and so just this half a point raise, this is one of the tools that the Fed has to try to say, hey, we're going to make money a little bit more expensive. So maybe it'll slow things down so that inflation just doesn't keep going through the roof. But it's really hard when, there's someone, in the government looking at the large picture, but that doesn't help you on a personal level,
No.
right?
No, that's true. If the Fed, they call it the Fed, the Federal Reserve, if they raise interest rates, they're doing that. Like you said, the housing market has been going crazy. I mean, housing prices have just been skyrocketing, right? So people were worried, are we then, these houses seem to be all overvalued by quite a bit. And car prices are going up. You can't buy cars. So by raising the interest rates, they want to maybe temper that. You can't even find new houses to buy, right? Because either they're too expensive or people are snatching them up and they're offering more than they're even asking. So I think that they're trying to temper that, right?
Well, they are, but it's hard because it's like it's starting like way upstream of the people. So like what the Fed rate does is that's the central bank and it sets the interest rates that banks use to borrow and lend money from each other. So that half a point is actually affecting the banks directly. And it's not necessarily going to help or change what the average person pays, but the thought is to slow the banks down about how they use money and lend money to each other. That's going to help downstream. But to even put it more simply, the higher interest rate means that borrowing costs more money because with the rate has been so low for a long time, Tony, that money was just cheap. And so we
Yeah,
were able
true.
to get car loans for years, like at 2 or 3%, and our housing loans were down around 3%. And that was a direct result because the banks were able to get money so easily.
Yep.
So the idea is raising it to cost a little bit more for the banks, that the banks will slow down. And then actually the hope is that maybe banks will start paying a little bit more for savings accounts and things like that. But the problem, Tony, is these things don't happen overnight. It's a slow
No, they
process.
don't. They don't. I mean, we see the headline in the news, the Feds raised the interest rate by 0.5%, and that's the largest single increase in over 20 years, but it's the media's hyping it. It doesn't immediately affect things. We didn't all of a sudden see, wow, it's not always instantaneous. Sometimes the markets react and people feel like the markets, had a few really drastic days, maybe after the announcement, because, somebody sneezes and the markets catch a cold for a few days. But again, nothing to be concerned about really, because, these things happen, right?
But what's gonna happen though is, of course, if the money's costing the banks more money, they're gonna pass on that cost to the consumer, which
Yeah,
is us. And
always.
so,
Yeah.
like, when you go, you've already seen it, that the loans that you can get on a home, they're higher. They're in the 4 or 5% range now instead of
Mhm.
the 2 or 3% range. And the rates on credit cards are going to be higher. So that's what's the immediate effect that we're seeing in our pockets is money costs us more. So our credit cards and the loans that we're able to get, those rates are going higher. So we're gonna see the cost of money to us is going to go up. So this goes back to kind of your spending habits and that notion, which is always good, that you don't ever want to carry a credit card balance if you don't have to.
Yeah,
And
because the rate hike, they say the rate hike is really going to affect things, and the more immediate things will be like credit card interest rates. They're going to use that. It might affect that quicker because the credit card companies see any reason. Oh, Fed raised interest rates. We're going to raise our interest rates on our credit card debt. Uh, you know, um, exponentially, and the Fed raises it by 0.5 point, and then you look and say, why am I paying 3% more on my credit card?
And it's just like everything is the credit card companies, it's kind of a little bit of a free market. So when they're
Mhm.
having to compete with each other to get customers,
Yeah,
they have to bring their rates down because they're being competitive. But
yeah.
now when the Fed's raised it a 0.5 point, they have a window here where they can throw your rates up before you know what's happened. And then you're going to have to be the one who has to start shopping around and saying, okay,
Right.
well, which credit card company is being realistic? But the immediate concern is that credit card bill that you've been kind of carrying every month because it hasn't frankly hasn't been that much money. You're going to be paying a lot more in interest, and
Yeah.
interest is not fun to pay because that's just money on your money. It's not for the thing you
Right.
bought. That's just for the use of money. And so
True.
you're a credit card again, like let's remember, Tony, a credit card is just a tool. It's a
Right.
tool for convenience.
It
And
is.
so what happens when the Fed's raising the points is that tool is gonna be more expensive than it was.
Yeah. That's true. That's true, and I think that's really good. People question black is, how is this affecting me? And credit cards interest is one of the way is that it's going to hit borrowers out there, and it's eventually going to affect things like you mentioned, car loans and home loans too. Eventually, right?
It definitely will start affecting those things, and this is just I can remember, 10 years ago when I was learning about real estate and credit cards and interest rates were a little higher, like, there was a thing you used to hear about, like, the interest-free balance transfer credits and those offers that the bank would send. So,
Sure.
those things are gonna come back, and then that's where you just have to get to be a savvy consumer and read the fine print. I think Chris and I got, an offer for a HELOC, and it was on the face of it, it sounded like it might be a great deal, but then you started reading the fine print and what the offer initially said it was going to be like a 4%. By the time it was all said and done, it was going to be like an initial 8.5%. So
Yikes!
you just have to
Wow.
be a very savvy consumer when you start looking at these things. And if something sounds too good to be true, read a little closer because it probably is.
Yeah, true, true, true. And HELOCs, have been good in some cases, but yeah, maybe bring it in. Have your financial services professional. I'm not going to name names, Chris and Tara Nolan, but have them look it over because I think that. A HELOC might be a good low interest rate advantage, but or option. Home equity is a big thing, and people have a lot more home equity now because homes are worth more.
Right.
However, you don't want to get into a bad situation. You got to read the fine print. And so many people don't. They just get into things that they probably shouldn't be getting into.
Well, and it's like every investment out there, and I talk about it in the book, Tony, is these things are all tools. And if the
Yeah.
tool serves your need, it's a good tool. But what becomes
Right.
very frustrating is you think you have a tool that's going to do one job, and then that turns out not to be what that tool does.
Right. Right. So, okay. And then I want to talk about what the rate hike does mean for homeowners in a minute. But first, let's take a minute to let our listeners know how they get a copy of your new book, Money Moves.
Sure, Tony. So for anyone who the offer that I'm making is anyone who sets up a complimentary discovery call and meets with Chris and I, we are going to make sure that you get a copy of the book, a free copy of the book Money Moves. You can also go to the website www.nolanfinancialpartners.com/money-moves, and you can also just buy the book from Amazon or Barnes and Noble. So those are all the options, and I love it if you would read the book because it's a great educational piece. It's got a lot of good stories and case study examples to let you really kind of sink your teeth in and go, oh, I can relate to that story. That's about me. And kind of just get an idea of what do you have that's working and where do you have some holes and gaps that you need to shore up. So that number, Tony, is 719-210-4242 to set up the complimentary discovery call. That's 719-210-4242. And we'd love to sit down with you, because for Chris and I, the most exciting thing is when we help someone get right on that path for success.
Yeah. Yeah. And there's great stuff in here. I mean, you're talking about the characteristics of a good investment, how just financial education and educating yourself can mitigate some of the fear that people experience during times like this. I love that. Money moves. Folks, give Tara a call, get a copy. You can also get it on Amazon.com or Barnes and Noble. It's great. I love it. And there's a lot of information in there, Tara.
And a good storytelling. So it's definitely not your
Yeah.
typical how-to book. And when I
Yes.
worked with the where we really made a point to say we want this to be something you can read, not something that's educational like a textbook. It's not like a
Yeah.
textbook.
It is not like a textbook, yet it is educational. So you get the bonus, but it's an entertaining read. It reads like an actual book. You put a lot of time and effort into it, and it's so obvious. Now, back to talking about what the Fed rate hike means for people. What does the rate hike mean for homeowners?
Well, this is where you're going to see it real up close and personal. Gone are the days right now of getting a home loan for 2 or 3%, because I think the 30-year mortgage has almost jumped to 5.5%. And
Wow.
it's the highest since 2009. And I know I talked about this before, Tony, but when I bought my first house in 1994, I paid 8%.
Yeah.
And,
Yeah.
at the time, I mean, I didn't know anything. That's just what it was. And so that's what I paid.
Yeah.
So, I don't want people to be scared, but here's the reality is what it's going to mean is the rate is higher. So your 20% down is going to be higher. So everything's just going to be more expensive. And it's going to mean you're going to need more help from your family, or you're maybe going to need a little bit more time to save for that 20% down is what that really is going to mean for folks.
Yeah. My wife and I paid 9.25% for our first home loan. And now we're at
Right.
2.7 or 2.8 in our current loan. And it's a 15-year. So we got a 15-year mortgage at 2.8%. So we're really happy with that right now. Compared to 9.25, people think, wow, it jumped up to 5.5%. It's been a lot worse. And I remember when in the 80s, there was a time when inflation and interest rates were, 12 to 14%. It got crazy. So
Right. And for the people that had a variable home loan, then this is going to be very impactful.
Yes.
So I'm a big fan of doing things in a fixed way if you can, because fixed, it means guaranteed, and at least what your nut that you have to cover is going to be. Variable always means it can go down, but it can go up.
Yeah, remember those horrible ARM loans? ARMs were the adjustable rate loans where the rate would go all over the place. You wouldn't want one of those now. So, or a variable rate loan. Those are never good. Hopefully you locked in when it's low. But you're right. A rate of around 6% is possible by the end of the year, they say. But again, there are ebbs and flows to interest rates as well. I'm really curious about whether the Fed's rate hike could have an impact on auto loans as well. We've already talked a little bit about credit cards. It's already impacting that. It's impacting home loans. But what about auto loans?
Well, Tony, and here's the part about money that's maddening is what I just told you about with home loans is I like the word fixed. Here is money making me a liar because auto loans tend to be fixed. But what happens is because the actual cost of the car, the price of the cars are going up, the payments are going to be much higher. So even though the loan rate is fixed, you're just paying more money for the car. So you're still going to have to pay more money. And it's almost kind of like to be a savvy consumer. You just have to know with inflation, things cost more right now And so it's
True.
you might think, well, okay, I just need to look for the word fixed. Okay, that's a great thing to look for, and I encourage you to do it,
Yeah.
fixed versus variable. But it's not always the only thing. And so that's why you have to take a holistic approach, Tony, and look at the problem from multiple angles to understand what you're truly getting.
Yeah, there you go. What are you truly getting? And you have to be careful with car loans. Make sure that you don't have balloon payments or changes to the interest rate after the initial. Sometimes they have a special offer, like 0% down, 0% financing, 0% interest. And when does that expire? And is all the past interest due then if you haven't paid it off by that date? And sometimes it is. So again, read the fine print, work with a financial services professional. Now, what does the Fed's rate increase mean for savers? What does it do to our savings?
Well, it's ultimately, it should help force the banks to pay a little bit more for money, because
Hopefully.
essentially where the banks were getting money from the Fed very cheap, the Fed is raised what that costs. So the other place where the Fed or banks borrow money is from you as a saver, because when you
Hmm.
save your money at the bank, then the bank takes that money that you put in the savings account and then they loan it out to other people. So what things the bank will do to entice savers to put more money in the bank is start to pay a little bit higher rate. It's been really low, Tony, like 0.06%.
Yeah, it's
Um,
been terrible. Yeah.
but it's the thing is that shift may happen, but it might happen more slowly. What we are seeing, and you can shop around a little bit, is some of the online banks have jumped
Hmm.
almost to a 0.5%. So that's a little bit more than some of the brick and mortar banks. So this is part of where you can be a savvy shopper. And sometimes you can start it's always a good time to start looking at, CDs or for some of these
Hmm.
high yield savings
Sure.
accounts, because those rates are gonna start to go up. And, it kinda comes down, it's also that supply and demand thing where the banks will start paying more if they need your money.
Yeah, true. True. You might finally see CDs or savings interest go up a bit. But again, that's going to happen more slowly. It's not going to be the same rate as the interest rate on your debts are going to go up much faster than the interest rates on what you're making. Unfortunately, that's just the way it works. But obviously, and we talked about this the past few shows, but inflation is taking a bite out of savings right now.
Well,
So,
yeah, and you almost wanna think about it like a horse race, right? So, the Fed is raising, the cost of money, so inflation is happening because the Fed's trying to bring that down, but the banks so inflation is rising, which means you need more money to buy the same thing,
right.
but your savings accounts, you're not being paid more in your savings accounts yet, so that means that the money you have doesn't have as much buying power,
Right.
and a simpler way to think about that is how much are you paying for a gallon of gas? You know,
Yeah.
you a couple years ago, we were paying, 2 to $3 for a gallon of gas. Now some places you're paying 6 or $8 for a gallon of gas.
Yeah.
So that dollar that you have is not going as far to buy the
Right.
same exact thing.
Yeah.
And
Yeah.
so
Yeah.
that's what you
So
just wanna think about it, that, your money right now is gonna be lagging behind. So inflation is happening and your money that what you're earning, your savings is not keeping up yet.
yeah, I got to take notes. This has been a great conversation, and you're pointing out some good things. One of the things I want to ask you is how does the Fed raising the interest rates does that affect stocks or the stock market?
Well, yeah, of course, Tony, everything is connected. And so, when the Fed increases the rate, borrowing becomes a little more expensive. And so that cost of doing business is costs more for public and private companies. So again, all of these costs get passed on to the consumer.
Sure.
And so as that supply of money and circulation contracts, so the whole point of this is right is there's more money in the system than stuff to buy. Think too many cars available or that don't have chips. So people want to buy cars and they can't buy them. So the Fed's trying
Yeah.
to make money more expensive so that people don't try to buy as much so that the car prices can't go up as much. So what's going to end up happening though is that's going to mean less money's in the market.
Yeah.
And so
Yep.
think about money like energy. Money is like energy moving around. And so when the money contracts in the system because it costs more, then everything just kind of slows down and that's what they're trying to do is to slow everything down so inflation doesn't keep going through the roof. But then that means at the individual person level, everyone's accounts are going to grow a little more slowly, and it's just going to
Yeah.
be like an overall contraction.
Yeah, and so that's going to affect businesses, which affects the market because the more it costs to borrow, obviously, the worse it is for businesses, right?
Right, because it's just like how easily money moves through the system. When you make it harder for that money to move through, then everything just has like a contraction effect and a slowing effect. And
Hmm.
that's not great at the individual lesson, and it's just one of those really frustrating things where if you look at the country's economy from that 30,000-foot view as
Hmm.
an entity, it's better for the overall country, but it's painful at every personal level.
Yeah, yeah, it is. It is, and you know, it can be a tough time for certain businesses as well, which affects individuals and affects the stock market, which is where we have our retirement funds. So, what I see, everything you're saying here, and what we're talking about, what all this leads to is, I bet a lot of people have been picking up the phone, calling their financial services professionals, which in this case, you and Chris. And so, for our listeners out there, though, if you have a plan and you're working with a trusted financial services professional, that's where you're going to not have to worry as much. You can sleep well at night. So, how can our listeners get that plan in place, Tara?
Sure, Tony. So definitely give Chris and I a call at 719-210-4242. That's 719-210-4242. And Tony, just like we've been talking about, this is what we do with our clients that are in the market is it's about the downside protection. Everything's good when the market's great. But this is
Yeah.
the time period where you want to have that downside protection so that you're have someone intentionally looking at your money every day and making sure that the best decision that can be made with the information available is happening, and that your money is not just riding up and down, because we just don't know how long this inflation downside period is going to last. And so what we want to do is you want to weather the downside in the best way you can.
Yeah, there you go. That's awesome. And so, listeners, get a copy of the book. Just pick up the phone and give Tara and Chris a call. What's that number one more time?
Sure, Tony. The number is 719-210-4242. That's 719-210-4242. You can visit www.nolanfinancialpartners.com as well.
All right. Yep. That's nolanfinancialpartners.com slash money dash moves. That's slash money dash moves on the end to go to the book site. Otherwise, there's a lot of great information on nolanfinancialpartners.com. A great website, too, by the way, Tara, with tons of information in the book. I just can't stop looking at your book. I love it. I love it. I love it. I hope all our listeners get it and read it because it is so good. I'm really proud of you for this book, and you did a lot of work. And I know you probably put, we got to give some credit to Chris because I'm sure you put him through a living hell while you were doing all this. This was really all consuming, right? So you put a lot of time and effort into that. But great show today, Tara. We're out of time. So, listeners, that does it for today's episode of NolanFinancialRadio.com.
Join us soon for another episode of Nolan Financial Radio. Take care, and we'll talk with you next time.